Welcome to Tony at 12. I'm Tony LeBlanc, and today I'm in conversation with Toby Birch, who is a senior investment manager at Gower Financial Services. We're going to take a look at what's been happening in the global markets in the second quarter of 2023 and a few other bits and pieces. Just to remind you, all opinions are personal and no investment advice is being given. As ever, good to see you.
Thanks, Tony. Yeah, we're looking forward to the Ireland Games starting next week. So,
are you participating?
Only visually by looking at it.
Let's have a look at major stock markets, Toby, over the last 3 months. Starting off with the UK, it sort of got somewhere and then sort of fizzled out, as far as I can see.
That's right. It's been really flat. I mean, some commentators have rather cruelly called the FTSE 100 the Jurassic Index.
Right.
Because it's full of old dinosaurs, which is a bit harsh. But when you look at what's going on in America, you've got Apple is now bigger than the entire FTSE 100 index. It either means we're very cheap or Apple's very expensive. I'm not sure which yet.
Or perhaps the answer lies somewhere in the middle. But exactly, that's quite incredible, isn't it? One corporation.
Yeah. It's just amazing. These things are often a sign that trends are about to change. So when it hits headlines, you know something is it's going to happen after this.
What about the US in general? That's in a fairly stagnant state, is it?
Well, it is, but if you look at the stock market, it all looks rosy on the surface. Because in the last quarter, the main index, the S&P 500, is up 5%, year to date up 10%, and you think, well, that's pretty good. All is well. When you look under the surface, out of the 500 companies, only 7 have gone up, but they're such a big component, and they're all related to tech and artificial intelligence, that these have artificially pushed up the whole index. But in reality, the most sensitive areas, what we call the cyclical areas of travel and consumers, these stocks are down by 1/3 this year. So the headline is really masking what's going on. So I'm sure clients are saying, oh, look at America, it's doing so well. Why hasn't my portfolio shot up likewise? And that's the reason. It's the most narrow market ever. And I liken it as an analogy to generals leading an army. So you've got like 7 generals dashing out the trench. Everyone's stuck behind, cowering away. So it doesn't look healthy.
It always makes me laugh when you look at Berkshire Hathaway, Warren Buffett's company, and you look at the original one, and the share, the share price is is it hundreds of thousands or getting on for $1 million a share, something crazy,
Yeah.
And lots of people said that when they got in with him and at the start and stuck with him, they've done very, very well. How about Japan? What's happening there?
Japan's done reasonably well on the surface. I think it's up about 3.5% in the last quarter. Japan and Asia have got very, very low inflation, and they're kind of ticking away, really. They've got the long-term issues, but they're really, like the UK, they're a very small part of the world index now, that they're kind of far less relevant than they were back in the late 80s when Japan was, all things to all men.
Yeah, I mean, it went through a really popular sort of situation in the 80s, and then it crashed, didn't it?
That's
and never recovered.
No, not really, no. It's looking quite good value nowadays, but lots of things look good value but don't go up, unfortunately.
Yeah. Retail bonds and gilts, lots of the prices now below par because of the increase in interest rates. Can you explain to us simply how yields work on these things, Toby?
Sure. I mean, when you buy a bond, typically you pay got a £100 layout, and each year you get your little coupon or interest rate of, say, 3%, a few years back. And that's all well and good. However, when interest rates change, this affects the way the bonds are priced. So that 3%, when interest rates shoot up to 10%, is pretty useless, really. So as the interest rates and yields go up, the price of the bond falls. So the way I think of it mentally, it's like a lever arm scale. So price goes down and the yield goes up, and vice versa. So in an era like a few years back where interest rates were close to zero, a 3% coupon or interest rate was fantastic. So the price of the bonds shot up over par, and that swung completely the other way. So it's a not a bad time for people looking for income to park some money there if you can live with a bit of inflation short term.
And of course, providing the company doesn't go bust, they've got the guarantee that they get the capital back when the thing matures in next year's time.
Yeah, and in some cases, the big companies that issue bonds are priced as well, or if not better than some governments. Which tells you a lot, really, about indebtedness.
Yeah. So it's an interesting situation. How does it compare with the mini budget crash? Because that sort of happened and had a big effect, didn't it, on pension funds?
Yeah. So, well, include the Bank of England in unpleasant tales. They bought some liability-driven investments. They're trying to ensure the way the pension funds operate, so they can produce income in the future. But of course, these things are just leverage or debt hidden in another form and repackaged by investment banks. So these blew up, and pension funds became forced sellers right at the bottom of the market, which is always the way these things work. So it's it was pretty chaotic back last October, and government prices fell pretty severely. I mean, they rallied afterwards and have since drifted down again with higher inflation and interest rates. So we're kind of back to where we started, literally 8 months ago.
But this second bout is more of a natural phenomenon rather than sort of a politician coming up with some ideas that obviously didn't work.
Yeah, it's a slow sort of death by 1,000 cuts, with inflation eating away at the value of your money and your bonds in this case, because these gilts are very sensitive to inflation because they only pay a fixed interest rate. They don't have like a growing dividend.
Yeah.
So when inflation comes along, the prices fall. It's one of several causes of that makes bond prices move.
Let's now talk about Thames Water, which seems to be an absolute basket case. It's £14 billion in debt. Half of the debt is linked to inflation. And what I didn't understand, I mean, presumably when it was privatised in the 1980s, 1990s, it would have been bought up by you and me and everybody else as part of that incentive to try and become a share owning democracy. So taking it on a stage further, it appears that it's now owned by a private consortium who presumably,
it's a variety of pension funds and sovereign wealth funds. I mean, most UK utilities are owned about 90% by overseas investors. But really, the rot really set in back in 2006 when Macquarie, the infrastructure private equity firm, came in. And I often rant about private equity, so I'll try and calm myself down. But often they take over a firm using leverage and they dump the debt on the company. And over time, they pay out these special dividends. And liken it to a cow being milked endlessly, and all you're left with is skin and bones. And then you try and sell it on for a higher price than you bought it. So they use a lot of semantics about growth and investment, but really it's about skimming off and draining the company of money and leaving it with a huge debt pile. So the CEO who walked away, it wasn't her fault. She just came at the end of a 15-year debt pile up. And it's exasperating because I like capitalism, it's pure form, but this debt-driven version is just like a Frankenstein, and it's a pretty ugly beast.
Is it a bit similar to Manchester United in terms of the fact that was all debt laden? Yeah. I
mean, this is just a common pattern throughout the UK. It's probably why inflation is so sticky as well, because wherever you turn, everything's laden with debt, and there's an interest cost in everything. So when interest rates go up, that which is meant to combat inflation, that creates more inflation because prices rise everywhere. So it's kind of it's almost like a death roll and a race to the bottom when you have companies owned by these heavily indebted institutions. And it's got to come to an end somewhere because everything's just been drained to its last ounce.
I mean, the question is, of course, can the UK government actually afford to buy Thames Water, because presumably they would have to compensate the bondholders. I don't know so much about the shareholders.
Yeah, it's a good question. We've got, I think they need about £1 billion to keep going for the next 18 months or so, roughly, which is certainly doable. What happens after that? Yeah, we just don't know. But obviously, you've got to keep the taps running to keep things going. So something we'll have to give. I mean, ultimately, if there is a swipe on the shareholders, this is people's pension funds, not necessarily ours, but someone pays along the way. So it's it's a real problem. And I always think of Buckaroo from the 70s as a child's game. You pile on the pieces, eventually it all falls apart. So hopefully it'll keep going for another 18 months. Then we'll see what happens.
How about the other privatizations? Thinking rail, gas, electricity. I mean, the argument is that the consumer is paying for the dividends for the shareholders, sort of thing, the whole time.
But it all started off so well, as you referred to, in the 80s, and we were all many people were shareholders on the sort of retail side, and it's like a virtuous circle of getting your dividends and you're getting more efficiency. Because really, if you go back to the 70s, I'm sure you remember how hopeless the utilities were. They were true dinosaurs. You had to wait, like communist Russia, where you had to wait to get your telephone or your car for years. And moving into modernity, they're now expensive and hopeless, but at least you've got a choice in theory. So it's almost come full circle where what started off as a great ideology has become mired with debt and has become tainted. And I just wish we could have stuck to the knitting and kept it how it was.
Interest rates going up, mortgage interest rates going up. They're talking about, possibly a fixed interest arrangement over a couple of years, hitting 7% shortly. Do you think that's going to have an adverse effect on the values of housing in the UK? Must do, mustn't it?
There's some extreme examples. If you go back and think who's effective, about a third of housing is mortgaged. So obviously they're going to be whacked. Particularly younger people who took out big mortgages to afford high prices. A third are renting, so they will eventually be whacked when landlords passed on the costs. And the other third are outright owners who've probably got deposits as well. So they're in the land of milk and honey, really, the best of both worlds. But having some extreme forecasts, I think Lloyd's have said even within a couple of years, there's going to be a fall by a third in the property market, which is very extreme. Others are saying that what we're likely to see is like a flatline effect, where we typically get a spring bounce in the market next year. That won't happen. So all these interest rates rises are really delayed. They have a delayed effect of about 18 months because of fixed rate mortgages. It's just like a process mechanism that goes through the economy. So America started first, and their inflation rates are falling. In the UK, ours are still too high, and the core rate which excludes volatile food and energy, that's still 7%. So there's got to be more pain to come, because central banks are basically trying to make up for the mistakes they made in the past, and the consumers are going to suffer, and homeowners as well.
Yeah, because I suppose part of the problem with the mortgages is the fact that the multiples of income were extended substantially because of the low interest rates. I mean, when I was young, and that's going back a long way, our mortgage when we bought in 1968 was 7 5/8. But having said that, they were a lot more prudent in those days as to how much they would actually lend you. So it's
the kind of affordability was there as well in terms of you think of price to earnings ratios in stock markets. It's the personal earnings to house price ratings, and because property's gone off the charts, it means that people just can't. They can never earn enough to get those multiples, so that they're kind of trapped in this yet more debt. I mean, everything really comes down to the flow of debt, and we're just utterly mired in it. Government, private, corporate, you name it.
Yeah. So what about the battle against inflation? When we spoke last time, Citicorp had prophesied that the UK rate would be down to about 2% by Christmas. Clearly, that's not going to happen.
Mm.
You say we're round about 7 at the moment. Do you have any thoughts as to whether or not it will go down, or will we find that increased wages will have an inflationary effect?
Yeah, I mean, this is the kind of conundrum, is that the inflation rate's going up, so people want more wages, and they're always going to be paid with a lag effect. So
Yeah.
everyone's getting gradually worse off. I mean, to be fair to the Citigroup or Citibank, this forecast is very much like the central banks. So really, they're trying to talk down inflation, and this is called so jawboning in market parlance. They're trying to beat the market down in expectations. And this happened in February. Stock market shot up because they thought rates would come down, and they haven't. As ever, we look to the States where inflation's starting to fall, but the UK is sticky. Again, it might be because of the effect of our retailers. I mean, the Competition Markets Authority is coming in, and they've told retailers to slash prices at the petrol pump. And I think they're going to report on the grocery sector next month as well. So there's a bit of what I call gouging of the consumer going on in the UK. I'm sure it happens in the States and elsewhere, but it seems particularly bad here. So inflation is kind of becoming self-fulfilling. The longer it stays higher, the more people push for wage rises.
Yeah.
And it's got a very 70s feel to it, unfortunately.
Yeah, that's right. Yeah. Sterling's not doing too badly, though, is it, compared with where it was after the Liz Truss quasi budget? That seems to have recovered a bit.
It has. I mean, this is part of the factor of that because our inflation is staying high, the expectation is for interest rates to keep going up. So it's sort of kind of on the front foot effectively relative to other countries where the cycle will turn from falling inflation, falling interest rates, and we're still out there putting interest rates up. So it's kind of a relative game, really. I mean, I think the exchange rate bottomed out at about 107 against the dollar, and it's now about 127. And very unusually, it's just in time for the holiday season, because normally it bombs out just
yeah, absolutely, yes.
It's a rare change,
And of course, the thing is that if you sort of think about oil and gas, it's priced in dollars, isn't it? So that's presumably having the effect of making these commodities slightly cheaper.
Yeah, I mean, if you look at a whole raft of commodity prices, they've absolutely tumbled this year. And again, talking about retailers, this isn't being passed on at all. So the profit margins are widening, and yet poor consumers paying yet more. I mean, and there's no excuse for it. I mean, the shipping rates have come down substantially. China's reopened, and lots of commodities are much cheaper. So it's very frustrating to watch. It's kind of the worst side of capitalism again, which isn't what it's about. It's meant to be about competition, bringing down prices, and creating greater equality effectively, and that's just not happening.
Let's get back to the thorny subject of chief executive officers, because we spoke about the lady that walked away from Thames Water. I was doing a bit of research the other day, and didn't realise how successful Archie Norman, a former Conservative MP, had been with a couple of companies that really needed a bit of a oomph, as it were. You've obviously had a bit of a look into him.
Yeah, I mean, he's one of these rare creatures that has been able to work in politics and commercially. And normally I'd say never the twain should meet. So people who are good at sort of government or civil service work should stay there. Shouldn't go into the private sector. And actually vice versa. You find some private sector people come to government and really throw the weight around and upset the apple cart, and it causes chaos. So it's kind of this stakeholder versus shareholder idea, and certain personality types fit in one rather than the other. So in the case of Archie Norman, he's a rare breed that could do both. Normally when they cross into each other's territory,
it doesn't work. But interestingly, I mean, Asda was a bit of a basket case. Not only did he pull Asda around, he was still an MP at that point.
It's incredible. I mean, one of my relatives was an MP for 30 years, and they generally do work incredibly long hours, and they have their they see their constituents at the weekend. It's not an easy job by any means. So obviously they get great pensions in the background, but for him to have done these 2 jobs is, again, he's an outlier, really.
He featured in a GB News interview a couple of weeks ago, which was very interesting, actually. And he sort of, somebody said to him, how is it you get these jobs? And he said, because no one else wants them.
Exactly.
So, on that basis, he pulled round ITV. I mean, that's back in the doldrums, admittedly, but during his reign there, it did okay. And now he's doing really well as chairman of M&S, Marks and Spencer's.
Yeah, they really turn around. It's amazing what, one person and it's almost like a philosophy. I think it's a phrase like philosophy will always out-trump strategy, because one's sort of corporate and dull, and another is a strength of feeling and a almost like a mission, if doesn't sound too evangelical.
Yeah. No, very interesting. If you can watch it, I would certainly suggest you should. Now, looking at the other end of the scale, a civil servant that went into business, Dame Sharon White, high-profile civil servant, chair of John Lewis, and she's presided over an absolute mess. And recently, the staff, or the partners as they're called, had a vote of no confidence in her.
Yeah, it's a great pity. She's a very clever lady and an academic, and is ideal in kind of government roles. So before she came to John Lewis, she worked at Ofcom. She earned about 300 grand, and then suddenly in the private sector she was on close to $1 million. And whatever you're paid, that kind of mindset doesn't work. I think she referred to using something called kinder capitalism, which sounds nice and fluffy, but when I first read that phrase, I thought it said Kinder, which is like German for child. In a sense, it is
inflammable.
It's a childish approach, and unfortunately, under her watch, the staff bonus has been scrapped for only the 2nd time since 1953. And I think that the rumor is she's going to go to the BBC, which is probably ideal for her. Like I say, nothing against her, but you can't put a fish on a bicycle and get it to cycle. So we will have our place, but
she'll end up in woke land.
Well, that's right.
You couldn't possibly comment, I know.
Ideal territory.
I was also thinking the other day about CEO salaries. I mean, 3 million a year, 5 million a year, etc., and you sort of think, how can you justify that? And then you look at the sort of money that a footballer commands, and that, up to a point, that brings the whole thing into perspective.
To an extent, I mean, there's a lot more highly paid CEOs than footballers, I guess. But probably America is the best place to look at extreme examples.
Yeah.
I mean, CEO salaries are a ratio of about 700 to 1 on average, and some firms at 1,000 to 1 in pay. So in the top 300 companies, a CEO will earn about $10 million a year. But what you don't see is the stock options in the background, and these are worth an absolute fortune. So when you see these companies take up lots of leverage to try and force up the share price, so these guys can cash in, and they're made for life. And you talk about people not wanting the job in some cases. The ones who do want the job are usually sociopaths who will do anything to get the share price up. So it's all about debt. It's all about short-termism, and it's just I feel exasperated to watch it, to be honest.
I mean, again, in your view, they're overpaid, a lot of these people.
They seem to be passed around like hot coals. They kind of fail in one job and go to another. There's kind of a formula, say, of just leveraging up and cutting costs, and I wouldn't say abusing the workforce, but certainly putting them last. And I'm kind of thinking of the past in the era of the Quakers, when you didn't need an ESG strategy or corporate governance. They just had an honest philosophy of how to treat people, and that is no longer here. And you can't just write a strategy paper and force this. It's got to, again, it's like a philosophy you have that maybe if CEOs are paid in a ratio to the average, it would encourage the kind of so-called trickle-down effect to help more pay, because it is a beneficial. This idea of people being paid more does have positive knock-on effects. We saw this after the Black Death, where peasants were empowered, and it really created a new Renaissance period. So it's not about saying workers getting wage rises is bad. It's actually good for everyone, and they get blamed for inflation, which isn't. It's not their fault.
Let's take a look at UK taxation. Is it sensible to increase corporation tax from 19% to 25% if you're trying to encourage businesses to set up in the UK?
As you probably guess, absolutely not. It's just the insanity of government thinking. If you look back to when corporate rates were cut, you actually get more tax taken. And it's this paradox, I think we discussed before, called the Laffer curve. You have an ideal tax rate of around 20%, where you've cut the rates, but you get more tax. And this idea of, it's like sort of GST in Guernsey, this idea of putting up taxes and getting more revenue has the opposite effect. It destroys activity and kills the economy. So it's frustrating to see, and I follow Liam Halligan in the Telegraph discussing this in great depth. And it's just a sign of desperation. And it's no wonder companies don't want to list in the UK, and why the index is so small as a percentage of the world, economy.
But as you say, lower taxation increases business, etc., etc. Why do these people not understand that?
Well, I mean, to be fair, we talk about Kwasi and the October budget. That was about cutting taxes. It's just so badly communicated that it fell flat in the face. So there needs to be some educational briefing for markets and economists. Say this is how it works. Although it sounds odd, by cutting corporate tax rates, we'll get more tax, and we can therefore give you more services, or cut your tax rates, your personal tax rates in future, as the Thatcher era. But everything seems to have gone wrong. I keep using the phrase Frankenstein. You got bits of policy glued onto another, and it looks pretty messy. And
of course, the other thing that we've got to bear in mind is the actual cost of decarbonisation. I mean,
it's highly inflationary.
Is 2030 realistic for the end of the internal combustion engine? I don't think it is.
It's absolute nonsense. And I went to a presentation with some energy specialists last week. I'll hold it up to the screen. This goes out to 2050, and the green bar shows the use of alternatives, which will be about 50% by 2050. So this idea of wiping out all fossil fuel use within the next 10 years is complete nonsense. But what you find is that with this movement, I call it net zero nonsense. You just say anything extreme and everyone nod and go, oh yes, that's very sage. Remember Al Gore, 20 years ago with his Inconvenient Truth film. We're supposed to be knee deep in water by now. And according to Greta, we should be at the end of the earth should have happened. So I just find that any message laced with fear, especially from a government source, is usually just nonsense. And if you go back, I'm not saying scientists in the 70s were stupid, but they were forecasting a new ice age.
That's right.
The trend was drifting down, and all they were doing is extrapolating a trend. But what many scientists forget, and as clever as they are, is that life isn't linear; it's cyclical. So
of course it is.
Things ebb and flow.
Yeah.
And if you extrapolate that up bit, it's going to look terrible. Also, if you start at the bottom of the cycle, the up bit looks very aggressive too. It's like saying, looking at the stock market chart from the bottom of the 87 crash, it's like, oh wow, that's really shot up, but it was just part of a
Yes.
So I get very frustrated with this because you keep repeating things like 97% of scientists say climate change is man-made. That was a completely fraudulent survey where people who disagreed got stripped out, like meteorologists. A third of them at the time said it wasn't man-made, so they got taken out of the survey.
But we are controlled, into thinking these things. I mean, I think I mentioned to you last time, I've got a friend who achieved a lot in the City of London. He's also a scientist, a geologist, etc., etc., and he just doesn't buy climate change created by human beings at all. He just won't have it, you know, and he has compelling arguments to prove that that's the case. Have to try and get him on sometime.
Well, that's right. If you unfortunately, put that on YouTube, you'll find it gets deleted, unfortunately, because there's a whole institutional thrust towards more taxation and more government control to punish us. And it is just frustrating to see this repetition. Of course, the younger generation now believe this completely. And if you dare to question it, you're a conspiracy theorist, or some sort of dinosaur with a, conflict of interest. But I say all these things are cyclical, and that they'll come and go. And what these organisations do is that they ride on something good, like fighting pollution, fantastic, and cleaning the air, excellent. But they'll tag on their philosophy to try and almost like a Trojan horse to force it through. So. It's a rant over. I'm sorry about that.
No. I mean, let's keep the rant going just for a few minutes, because I hear now that banks are closing accounts if the customer doesn't comply with their views on minorities. And this happened to a vicar who was invested with a certain building society in an area where a test match is going to be played today. Yeah. They sort of said, "Oh, we disagree with your views. We're going to close your account." That's dreadful.
Yeah, of course, it sets a terrible precedent. I mean, obviously, no one wants minorities to be targeted, and but what's happening now is that you set a precedent like this, where you say that person is bad, close their account. It can then be turned around and used on anyone. So we saw in Canada when you had the truckers' strike, the PayPal closed accounts. You can use any excuse to close an account now, and banks aren't that keen on opening accounts anyway. And in the case of Nigel Farage, they said, "Oh, he's a politically exposed person, and therefore we can close his account." And someone used parliamentary privileges to accuse him of taking Russian bribes. There's no comeback on the person who said that, but he's now been forced to close his accounts at Coutts. And they've said they're backpedaling, saying, "Oh, we'll have a NatWest account." But if you let this go once, it's like the old philosophy of first they came for the Jews, then they came for me.
Yes, absolutely, yeah.
Get away with it, and then you'll find yourself at the end of these restrictions and not being able to live. And now we've got central bank digital currencies coming. This is the ultimate control mechanism, and this is why they want to destroy cash and take away that freedom. So it can go down a rabbit hole on this, but all these sort of nice soft sayings, go electronic, it's all great. It's a bit like the child catcher in Chitty Bang Bang.
Yes, absolutely.
Yeah, wonderful. Yeah. And as soon as you get behind the bars,
you find out what life's really all about. What are your hopes for the next 3 months?
Bizarrely enough, quite positive. I think that there will be some slowdown coming through, which is good for markets.
Yeah.
And what you saw back in 1982, when inflation and interest rates were very high, they start to come down. It really was a blowout year. So I'm not forecasting this is going to be an amazing, next 6 months will be amazing, because the first 6 months have been pretty flat for most people. But I just think whenever the public mood is quite morose, and certainly when professional investment managers are negative, it's normally the time you get a change. I mean, I tend to think of this phase that we're in now like as a summer doldrums. If you think of the doldrums, this is where near the equator, ships can't move in the old days.
That's right. Yeah, nothing happening.
The hotter it goes up and doesn't blow into the sails. And it's like it reminds me of the rhyme of the Ancient Mariner, which if you've got 13 minutes, you can read, or you can listen to Iron Maiden's version, which having just been to their concert this week, I'm happy to
Mr. Zoom tells me there's less than 5 minutes. So unfortunately, we'll have to do that another time. Anyway, I'm glad you enjoyed the Iron Maiden gig. I know you're coming over to Alderney shortly. Looking forward to seeing you then. And we'll have the full works then, if that's okay. Meantime, Toby, thanks ever so. Very interesting as ever. Really appreciate your participation. Take care, and we'll go from there. Okay.
Cheers.
Thank you, Toby.
Bye-bye.